Bonds are a type of fixed income investment that function as a loan from an investor to a borrower. Typically, the borrower is a corporation or a government entity. In return, the borrower agrees to pay back the principal amount on a specific maturity date along with periodic interest payments, which provide a predictable income stream for the investor. There are several types of bonds that investors may encounter. U.S. Treasuries are government-issued and considered low risk. Corporate bonds are issued by companies and carry higher risk but potentially higher returns, while convertible bonds can be converted into a predetermined number of the issuing company's shares. The face value, also called the principal, is the amount the bondholder will receive when the bond matures. It serves as the reference point for calculating interest payments and is typically set at a standard amount, such as $1,000. The coupon represents the periodic interest payments made to the bondholder. These payments are promised by the issuer and are usually made annually or semi-annually, providing a consistent income stream. The maturity date is the point in time when the bond's principal is repaid to the investor. It marks the end of the bond's life and the conclusion of any coupon payments, assuming all terms have been met. The term refers to the amount of time remaining until the bond reaches its maturity date. It can influence the bond's price, yield, and risk profile, with longer terms typically carrying more interest rate risk. Suppose we have a $100 bond with a 10% coupon rate and the bond pays interest quarterly. The coupon rate is defined as the annual coupon payment divided by the face value, multiplied by 100 to express it as a percentage. To find the actual coupon payment, we use the formula. Coupon equals the coupon rate multiplied by the face value divided by the number of payments per year. Plugging in the values, 10% of $100 divided by 4 quarterly payments, we get $250. This means the bondholder will receive $250 every quarter. Yield to maturity, or YTM, is the discount rate that equates the present value of a bond's expected cash flows to its current market price. These cash flows include periodic coupon payments and the repayment of the bond's face value at maturity. YTM is a key metric for assessing the return an investor can expect if the bond is held to maturity. To compute the present value of a single coupon payment, we discount it back to the present using the formula shown. This accounts for the time value of money, meaning future payments are worth less today depending on the discount rate, denoted by R. The bond price is the sum of the present value of all coupon payments and the face value, using YTM as the discount rate. Thus, the bond's market price reflects its cash flow structure and the market's required rate of return. Zero coupon bonds are unique in that they do not pay periodic interest. Instead, they are issued at a discount and repay the full face value at maturity. Since the coupon is zero, investors earn a return purely from the difference between the purchase price and the amount received at maturity. In this example, a 1-year zero coupon bond with a face value of $1,000 is trading at $950. Using the yield to maturity formula, we solve for the rate that equates the present value of $1,000 to the $950 price. This gives a YTM of approximately 5.26%. It is important to note how a bond's price responds to changes in yield to maturity. The example uses a $100 bond with a 10-year term and a 10% coupon rate, making quarterly payments. When the YTM matches the coupon rate at 10%, the bond trades at par, its face value of $100. If the YTM rises to 12%, the bond price drops to $88, reflecting a discount. When the YTM falls to 8.5%, the bond price climbs to $110, trading at a premium. This behavior highlights the inverse relationship between bond prices and yields. As yields rise, bond prices fall, and when yields decline, bond prices increase. If market yields are higher than the annual coupon rate, the price of the bond has to decrease to match market yields. And similarly, when market yields are lower than the annual coupon rate, the bond becomes more attractive to investors, and the price increases.